We have question 2 for AS Accounting, paper 1, 2024 May. So for question 2, they said, Ashani is considering purchasing an electrical retail business. She has identified 2 businesses that could be purchased, Alpha Stores and Better Bargains. The following summary financial information is available for both businesses. Alpha Stores has its revenue, cost of sales are there. Okay, its cost of sales and its expenses. These are extracted from the trading profit and loss account. Okay. Then it has its balance sheet, trade receivables, trade payables, non-current assets, cash and bank, inventory, and bank loans. Now, they said the inventory on May 2023 is for Alpha is 28,000. That's opening inventory for Alpha. For Better Bargains, opening inventory is 48,000 because the year starts in May 2023. Alpha Stores had the following profit for the year as a percentage of revenue in the previous 2 years ended 30 April. 10% in 2022. That's net profit for Alpha in 2022 and in 2023. 10%, 8%. Start reducing. Yes. The bank loan for Better Bargain is repayable on 30 September 2024. That's a short term because it's going to play within a year. And if you are paying within a year, it's a short-term loan. So they use loan here to convince you, you're going to think it's long-term. When you are calculating for your trade payables, you won't want to calculate it. Then you get it wrong because they said it's a loan. And you will consider a loan to be like long-term. Okay. So when you're calculating your trade payables are current liabilities, not non-current liabilities. So you wouldn't think about it. So it will make your current liabilities, current liabilities to be wrong. So, but put it in mind because it said it's paying back within 2024. 2023 to 2024 is 1 year. And a current liability should end within a year. Non-current is after 1 year. You get the point here? So all purchases of Alphabet Stores and Better Bargains are made on credit. Now we're told to calculate for each of the following. Better Bargains gross profit as percentage of revenue and Alpha Beta. So we have to calculate for the gross profit as percentage of revenue for both Alpha Stores and Beta Stores. To do that, we have the gross profit for both of them. Gross profit now will be, what is formula for gross profit? Gross profit is sales minus your expense, your cost of sales. Sales minus cost of sales. So our sales is 800 for Alpha Beta. It's 800 minus 480, which is the cost of sales for Alpha Beta. So that gives us 320. Are you seeing it like this? Okay, 320. Then for gross profit percentage, it will be 320 over 800 multiplied by 100. Yeah. So that gives us 40%. So that's gross profit for Alpha, 40%. Yeah. Then for Beta, we do the same. 800 for Alpha for Beta is 800 minus 420. It's different. The cost of sales is different here. So for Beta, it is 800 minus 420 over 800 multiplied by 100. So for Beta, it is 47.5%. 47.5%. Do you get that? Yeah. Okay. We're told to calculate for profit for the year. So let me just do it in the worksheet here. Let me do it in the worksheet so that you're wasting. Worksheet. Yeah, so we did the first one already, right? So we'll go to B. Profit for the year. So profit for the year will be, let me do that back again for Alpha. Alpha is gross profit as a percentage is 800 minus 480 over 800 multiplied by 100. That gives us 40%. 40%. For Beta, yeah, it is 800 minus 420 minus 420 over 800 multiplied by 100. That's 47.5%, 47.5%. So we go to question 2B. Profit for the year. For profit for the year, it is net profit over revenue multiplied by 100. So for alpha is net profit 320 minus 300 over 800 multiplied by 100. And for beta, it's the same. For beta, it's 380 minus 260, 380 minus 260 over 800 multiplied by 100. So for alpha, it is 2.5%. And for beta, it is 15%. 15%. We move on to question 3. They said inventory turnover. For inventory turnover, it is sales divided by 30, which is cost of sales over average. We have inventory turnover is cost of sales over average stock. Average inventory or average stock is the same. So here for alpha, we have our cost of sales. Our cost of sales for alpha is written in the book. It's 480. For cost of sales, it's 480. Let's check. For alpha cost of sale, 420 for alpha, 420 for alpha, 420. Then average stock is opening stock plus closing stock divided by 2. Opening stock plus closing stock divided by 2. Our opening stock for alpha, opening stock is 100 and no, opening stock for alpha. Our opening stock is 48. Our closing stock is 38 divided by 2. So we have average stock is 48, which is opening, plus closing 36. So that gives us 84 divided by 2, and that's 42. So alpha is 420 over 42, which is 10%.
10%.
10 times, because it's inventory turnover time. So it's 10 times. 10 times. Then for beta is the same formula, cost of sales over average inventory. So cost of sales for beta is cost of sale is 480, and the average inventory is 30. So cost of sales is 480. 480 over average inventory, which is opening plus closing. Opening is 28, closing is 32 divided by 2, that's 60 over 2, which is 30. So 480 divided by 30, that's 16 times. So inventory turnover for alpha, or for beta is 16 times.
16 times.
So we'll move on to current ratio. For current ratio, it's current asset divided by current liability. Current assets, CA divided by CL. That is current ratio. So for alpha, it's current assets.
Yes.
It's current asset minus closing inventory. Current asset is 110 minus closing inventory is 36. 110 minus 36 over current liability, which is 65. Gives us 74 over 65. So that is 1.14 ratio 1. That's for alpha. And for beta, it is current asset divided by current liability. For alpha, for beta, it's current asset is 72 over 45. So it's 72 over 45. So it's going to give us 1.6 ratio 1. Okay. That's current ratio. The questions are on the top there. Then we have liquid asset test ratio. For liquid asset test ratio, it is current asset minus inventory, closing inventory. It's current assets,
closing inventory,
current assets minus closing inventory over current liability. Closing inventory. You have to know the formula, please. over current liability, current liabilities. So for alpha is current asset for alpha. Current asset for alpha, we have, for the current asset, we have trade receivable, inventory, and cash. But there's something I think I want to let you know. This is alpha, okay. For alpha, the current asset is trade receivable, inventory, and the cash. Look at the cash there. Go back to the question. Let me quickly go back. Cash. Yeah, for alpha, look at it here.
20%.
No.
Oh, here.
Yeah.
That is,
For alpha, where is alpha?
bigger.
10% debit. That is an overdraft. This is overdraft. So it's not going to be part of cash.
Okay.
Credit means debit in your bank. Credit here means you have cash in your bank account.
Okay.
Debit means you are owing the bank.
The bank.
Do you understand?
Yes.
So they did it this way to convince you to. So you're going to, for those who are going to calculate current assets, you're going to think cash is part of your current asset, but this is a current liability now. Is what? Current liability, because it's an overdraft. Current liabilities is an overdraft. Let me quickly go back here to explain it. There's a situation here. We have our current liabilities here. Okay. The little details are the problem there. Now let's go back here. So look at, for the balance sheet, there's a cash and bank balance for 10 as debit, 24 as credit. 10 represents a liability, which is current liability. So this is a current liability, which is overdraft.
Yes.
Overdraft. And this is current asset. 24 is current asset, which is cash at bank. Cash
At bank.
at bank. I think that is clear. So go back to the question. Always take note of those things, please. Okay. All right. So we said asset test ratio is current asset minus closing inventory divided by current liabilities. So our current asset for alpha are trade receivable and inventory. Just trade receivable and inventory. I wrote them excluded overdraft.
Okay.
So that's current asset will be 40. This will be 40. Okay, it should be 40. 40 minus 40 plus 32. 40 plus 32. 40 plus 32.
That's 72.
Yeah, so that's 32 plus 40. That's 72. So 72, that's for the current asset. The current liabilities are trade payables and the overdraft.
Okay.
Trade payable is 35 and overdraft is 10 cash. So that's over 35 plus 10, that's 45.
Okay.
So for alpha, the liquid debt ratio is 72 divided by 45, which is 1.6 ratio 1. Get that? Then for alpha, or for beta, it is the asset ratio is 110 minus 36. The current asset minus closing inventory divided by current liability. So it's going to be 110 minus 36 over 65. And that gives us 1.141, 1.14. 1.14 ratio 1. So go to question 6. They said trade payables payment period. For trade payables, for Alpha, trade payables period is trade payable divided by cost of sales. Trade payables divided by cost of sales. Trade payables
Cost of sale.
divided by cost of sales. Cost of sales. So for Alpha, the trade payable for Alpha is 55. Total is 55. 55 over 420. 55 over 55 over 420 times 365. That's 48 days. All right. Then we have for beta, it is the table is 35 over 480 multiplied by 365. That's 27 days. So 27 days for beta, 27 days for beta. That's the payment back period, payable period, and for Alpha, it is 48 days.
Yeah.
48 days. Now for collection period of trade receivables.
Collection period for trade receivables.
Yeah, so it's going to be trade receivable divided by cost of sales multiplied by 365. Oh, trade receivable multiplied by revenue. Trade receivables divided by revenue multiplied by 365. So for Alpha, trade receivables for Alpha. Okay, for Alpha, that's 3. For Alpha, the trade receivable is 40. 40. So it's a 40 over 800. 800 multiplied by 365 for Alpha. And for beta, it's going to be this Alpha. And for beta, it's going to be trade receivable for beta. It's going to be 50 over 800 multiplied by 365 for beta. So for Alpha, I'm going to have 40 multiplied by 365 times 800. What does that give you? 40 multiplied by 365 times 800.
That gives you 11,680,000.
Divided by 800. It should, no, 40 times 365 should be 14,600. Do that again.
Okay.
40 times 365.
14,600.
Yeah, divided by 800.
18.25.
So we have 18 days to pay for its customers to pay back. That's Alpha. And for beta, 50 multiplied by 365 divided by 800.
Yeah.
What does that give you, please?
Or 65 times 800.
50 times 365 divided by 800.
22.
20.
20.8.
That's 23 days. 23 days for trade receivable. I think that is clear. So move on to B. It said, comment upon the following. Profitability of Alpha stores. Now, for profitability of Alpha stores, the gross profit is reasonable, it's 40%. Gross profit is 40%.
Yes.
And that is reasonable. Reasonable. But net profit, that is where it's problem. The problem is the net profit is, but net profit is 2.5%, right? Net profit is 2.5%, 2.5%, which is a decline in profitability. In the previous year, it makes 10%. It makes 10%, then 8%. In 2023, it was 10%. In 2022, 10%. In 2023, 8%. But now it's 2.5. So that is profitability is decline. So compared to the previous years, compared to previous years, 10%, 8%, now 2.5%. Decline in profit. Decline in profit. Do you get that?
Decline in profit.
Yes. Then liquidity of better. For liquidity of better, we're going to talk about how it can turn, that's current assets. So for the liquidity of better, the current ratio is 1.69. Current ratio is 1.69. That is acceptable. The current ratio, that's current asset divided by current liability. It gives us 1.69. 1.69 acceptable. Acceptable. Its acid test ratio is 1.14. That is strong. Acid test ratio. Acid test ratio. 1.14. That is strong. Then the receivables are 23 days and payable is 48 days. Receivable is 23 days. Receivables, 23 days. It means it's going to take 23 days for its customers to pay back. That is too long.
Yeah.
So that means it's not going to have cash within a month. So the last 7 days of the month is when it's going to have cash, and that is too long.
Yeah.
So receivables, 23 days, that's slight slow. Slight slow. But it's payables.
Yes.
When he's going to pay back to his suppliers, it's 48 days, right? So that is long. Good for cash. 48 days. 48 days. Long, and that's good for cash flow. Long, good for cash flow. Good for cash flow. When this is the point, to have cash, you need to reduce your debtors and increase your creditors. So if you are going to pay back your creditors in 48 days, it simply means you have cash long enough to use. If your debtors are going to pay you after 23 days, it means you might not as well have cash to run the business. So a long trade receivable reduces cash flow. A long trade payables increases cash flow. Do you get that point? Okay. So that's about that. Now, this time we should explain what goodwill is. I wrote goodwill is an intangible asset. It's an intangible asset because it's not handy, which represents the value of a business. It talked about the brand of the business, how profitable the business is, and the kind of customers the business has. That is goodwill. So goodwill is an intangible asset, is an intangible asset representing the brand, representing the value of a business, the value of a business, reputation, the customer loyalty, and ability to earn higher profit, ability to earn higher profit. That is goodwill, higher profit. I think goodwill is clear there. Okay. Now they said 3 reasons why Asheni may be willing to pay for the goodwill. What are the reasons why you want to pay for goodwill? One, because it can allow you to make more profit. There's brand reputation, and I think it has a strong customer base. So one, I wrote, the following reasons may allow Asheni to pay for goodwill. One, established customer base. Established customer base, established Customer base. Customer base. 2, strong brand. Strong brand. And 3, ability to earn higher profit. Ability to earn higher profit. So these are the reasons why you might want to pay for the goodwill of a business. Now, the same we should calculate the value of the goodwill that Asheni would have to pay if she were to purchase better bargains for 100,000. To calculate for goodwill, goodwill is purchasing power or purchasing price minus net assets. But first, we have to calculate the net asset. And what is the net asset? Current asset minus liability. So here, the asset for better is trade receivable, which is 50, inventory, which is 36, non-current asset is 80, cash at bank is 24. So the total of asset is 190,000. So asset for better, assets is 50 plus 36 plus 80 plus 24, according to the extract. So that gives us 190. Then the liabilities are trade payables and the loan, which is 10. That is where I was talking about the loan.
Okay.
10. So which is 55 plus 10, which is 65. So net assets is asset minus liability, which is 190 minus 65. That was 125. Do you get that? Now to calculate goodwill. Goodwill is purchase price minus net assets. The purchase price is 100. And the net asset is 125. That's minus 25. So that's a bargain. So if Asheni pays 100,000, the worth of the business is 125, and that's a good bargain for Asheni. Do you get it? So negative there. So negative goodwill. So a negative goodwill is a bargain for the owner or for the buyer of the business. Negative goodwill. Do you understand what I meant here? That's a bargain purchase. You're buying less. Bargain purchase. That was about that. Now, the last question says, for question 2, they said, evaluate the use of information, ICT. What are the uses of ICT? You're going to talk about the advantages and disadvantages. So the advantages of ICT in business are: 1, it helps faster and more accurate record keeping. 2, easy financial analysis and reporting. Improved communication and efficiency. It also reduces human error. Computer would reduce errors. However, the initial setup cost is high. To use ICT, that means you need different applications, different software programs, and that might be expensive at the initial stage. 2, it has the risk of cybersecurity threat. 3, system failure can disrupt operations or offline situation. Then, in summary, ICT greatly improves efficiency and decision making, but requires investment and proper management. So I'm going to write that out. Advantages of ICT. It helps faster and more accurate record keeping. Easy financial analysis and reporting. Easy financial analysis and reporting. Improved communication and information. Improved communication and efficiency. Improved communication and efficiency. It reduces human error. It reduces human error. However, the initial setup is high. It is expensive to set up. It is expensive while setting up. Setting up. It has risk of cybersecurity threat. It has risk. It has risk of cybersecurity threat. Cyber security. Cybersecurity threat. System failure. System failure can disrupt. System failure can disrupt operation. Disrupt operations. Because an evaluation, then you summarize. In summary, ICT greatly improves efficiency and decision making, what needs investment and proper management. And proper management, proper management. So that's about question 2. So you can go to them.